So macroeconomically speaking, I think we are potentially in a recession. I think we've been potentially in one for a long time because, as you know, inflation numbers are grotesquely underestimated. And if they're reporting a GDP of 2.5%, 3%, and the inflation numbers are off by 4%, then it means you're actually shrinking your economy. And on top of that, if you look at what's growing, Facebook and, stupid companies like that, it doesn't feel like wealth at all. It doesn't feel durable. It doesn't feel, it's not like you've created a new rail system. It's not, you can say, well, digital, you have digitally, but it just seems to be garbage to me. If Facebook dissolved today, I wouldn't notice it missing at all. I don't, you know. And Twitter would be disappointing because it's kind of like the equivalent of watching TV. So it'd be like if you took away my TV or something, it doesn't make you more productive. It doesn't. And Microsoft they make the same stuff they've always made, right? There's not. When I reached the point where I could paste a graphic into a Word file, that was pretty much the epitome of efficiency for me. And and then there's this crazy the overvaluation story. So at 15, I made, in my opinion, was a profoundly compelling case that the markets had not only rallied back from the '09 low, which was not very low. If you look at valuation metrics, we plumbed sort of historical fair average valuation, got a little below it, spent about a month below it, and then boinked right back thanks to $30 trillion of what they like to call stimulus, which is a euphemism for inflation. But by 15, what's interesting about the year 15 is this weird composite of we had learned what had happened in 08, 09 and had worked through a lot of it. And we were starting to notice that no one was going to get arrested. Nothing was going to change and stuff like that. So the 15 was a good year to sort of analyze the disaster, do a post-game recap. But what's also true is using stats, using graphs, using all the usual tools, using quotes from the world's most famous investors, Druckenmillers and Gundlachs and Paul Tudor Jones. They all said the markets had become ridiculous again and we're heading off a precipice. Now, what has happened since 2015? Straight up. And I don't think any of those guys would have believed if you had told them back then that it would go another 10 years. And I don't think any of them would have. I don't think anyone saw that coming. So, and that's how you get to 200% over historical average valuation. So something is elevating these markets in almost a sci-fi kind of way where the place you can see it the best, interesting, if you said America, but Germany. So you can read articles about Germany. I read one the other day that talked about how Germany's economy is a complete disaster. It's in a deep recession. It's got nothing to show for itself. I think the Ukraine war was a major problem for them. But they've been getting the crap kicked out of them. The DAX has gone parabolic. So the markets no longer in any way respond to the realities of the world. And you can have potential bad news. Let's pretend tariffs are bad news. I have no idea, actually. These tariffs are a little different, right? There are a lot of noise, a lot of negotiating, a lot less tariffing, probably. The tariffs may look like a threat. There's 3 guys left in the world who've got the lack of brains. They're required to try to short, to sell it, right? And then it passes and the world kept spinning and it wasn't a big disaster. And all of a sudden millions appear to buy the dip. Mm-hmm. And so you've got this totally unsymmetric response to news. When the bad news is there, you got the three Three guys are willing to short the market. And when it turns into not such bad news or good news, everyone wants to buy it. And so that's how you elevate. You get the Mike Green story, right, where it's passive flows. I mean, that's never going to stop. Mike Green says it is stopping. It will stop. It will stop at some unknown future date, but at some point it's going to reverse. One could argue, as the boomers have to start spending down their money. If the market somehow starts correcting, then all of a sudden people start liquidating. If you've got an S&P 500 Vanguard fund and you decide you want to sell, in the olden days, you would say, oh, I should sell that NVIDIA, or I should sell. Now you can sell the entire market with one click. And so it is going to be a market-wide, and if you think you're buying a good stock because it's a value play, first of all, make sure you're using the absolute metric of value. So if you say the small caps have never been this cheap compared to the large caps, whatever argument you want to make, be careful. Your metric, choose the wrong metric. What you want to do is say, is the cash flow of the small caps higher than it's ever been, right? Relative to the market cap, things like that. Those are absolute values of valuation. And a husband once went through the analysis. He says, when markets sell off all 10 deciles of valuation, you break it into 10 deciles of dirt cheap, probably for a reason, expensive, arguably for a reason. They all sell off about the same. And so by the end of a big problem, you're selling your grandchildren, you're selling your children, you're selling your house, you're selling everything.
Right?
Yeah, you're right. And literally in the Depression, there were actually parents giving away their kids. And again, this doesn't feel like a euphoric top. And so on top of all this, if you take the average boomer who's still pissed at the COVID story, and still pissed at the Ukraine story, and still pissed at the Israel-Gaza story, which they won't say anything about, but you can't watch that and go, wait a minute, this is a problem. And then you take away half their net worth. So all of a sudden the salve that was keeping them from losing their shit has now been removed, right? And if you lose 10% off your retirement account, you just took a 10% pay cut. And you go, well, they got pay raises repeatedly for the last 10 years, right? And it's rather extraordinary. So, for example, the example I like to use, let's start real simple. If I've already said this, just stop me. But at the end of the dot-com drop and then rebuild, Buffett lamented hanging on to Coca-Cola. Now, that didn't got a lot of press. And what most people think is Buffett would never sell Coke because he's in love with the goddamn company. But he did lament it. And the reason he did is because Coke had hit a PE of 50 in 1998. And that means to a guy like Buffett is they had a 2% cash flow. And Buffett knows that if you got a 2% cash flow, that's the return on your investment, right? Think of stocks and bonds just being cash flows. You're getting a 2% return. It could go up from there, but it could go down from there, right?
Significantly, right?
Significantly. And that was a time when 10-year treasuries, I think it was, were trading around 6%. So Buffett realized that he hung on to a 2% when he could have had an absolute rock solid safe 6%. So now you go to the 2015 to 2025 window. Microsoft, its revenues are up 150%. Oh, that's really good, which imparts inflation, right? But its share price is up tenfold. And my math tells me that the share price should crudely track the revenue growth, right? You look at Apple, which hasn't invented anything new that I can see. I'm sure there's some cloud shit, right? But I don't care about the cloud shit.
Apple invented I just got a new iPhone and they invented a new cord that I had to go buy.
And it's the same phone though. It's the same phone. Right.
Yeah, it's how they're generating revenue is exchanging the how I plug my phone in and not.
So Apple's up tenfold, and its revenues are up 50%.
Yeah.
So one could argue to undo that expansion of valuation. That's a 95% correction. Now, got to be careful because they did share buybacks. So instead of looking at share price, arguably you should look at market cap, and the numbers shrink a little. So it's like Apple's up, sixfold with a 50% revenue. And that accounts for it, but it doesn't account for the fact that they burned their balance sheet down to a nub. So you kind of got to back that out. And I don't know quite how to think about that, but so all these and NVIDIA, right? NVIDIA's revenues are up 25-fold, right? So they're trying to label this the AI bubble, which I think is a fake. And the reason I think the label of the AI bubble is fake is it's almost like they want to ring fence it so that when it goes to shit, they can say, okay, just sell the AI stocks.
Right.
Buy Coca-Cola revenue, whatever, right? And I don't think that will work. And but NVIDIA is up 25-fold increase in revenues. Now their profit margins are ridiculous, and profit margins mean regress like nothing else. But also on top of that, Huang has got a history of being a slimeball, and on top of that, their share price is up 250-fold. So a 90% correction using share price would get them back to where they were in 2015.